I'm Professor Indra Abeysekera. In workshop 3, one of our learning goals is to understand principles behind recording transactions. Just to recap, there are debits and there are credits. Debit is the mnemonic for debits and lie is the mnemonic for credits. Dividends, expenses, assets and drawings are the debits, and liabilities, income, equity are the credits. Equity can be expanded further, and there's revenue and expenses. Revenues are normally credits. They are recorded as credit items on the right hand side. Expenses are normally recorded as debit items or on the left hand side. When we record transactions, we need to follow some principles. These principles are built-in assumptions in accounting. And these principles are collectively called generally accepted accounting principles. They're known as GAAP. So let's look at these principles. The first principle is the time period principle. In accounting, the time period is divided into artificial beginning period and an end period. And that period can be determined by the organization. It could be a month, 3 months, or a year. Most organizations use a year as a definite time period. So time period principle is the first principle. So when accounting information is produced, it is produced for that time period. It could be a month, quarter, or a year. The second principle is called the accrual basis principle. Transactions are recorded in the period the event occurs. Transactions are recorded in the period the event occurs and not when the cash payment or the cash receipt occurs. So the accrual basis principle supersedes a previous principle called cash basis principle, where the transactions were recorded when the cash was received or cash was paid. But the accrual basis principle that is now being used records transactions when the event occurs. That means the cash may not have been received, cash is yet to be received, or cash is yet to be paid. We know that when cash is yet to be received, we call it receivables, and cash is yet to be paid, we call it payables. The third principle is the revenue recognition principle. Revenue or the income is recognized when the organization has delivered the promise to the customer. That means customer is satisfied with the performance obligation that was promised. Until such time, the revenue is not recorded or the income is not recorded because the customer has not contractually received the product or the service to the satisfaction. The fourth principle is the expense recognition principle. It's also called the matching principle. It is because expenses incurred are matched with the revenue that is being recognized. So it follows the revenue recognition principle. When the revenue is recognized, whatever expenses that was incurred in earning that revenue, that income, is being recorded at that time. So it follows the revenue recognition principle, and that is called the expense recognition principle. So there are 4 principles.